Hi, my name is Tony Yang. I'm head of growth here at Mucker Capital. And some of you who've been part of Mucker for a while have seen me around. You've been meeting with me. You're probably sick of hearing from me yap about certain topics. This is why it's always great and refreshing for me to invite other experts in our partner network and just friends that we trust and know. And Steven being one of them. He is the co-founder and CEO of Forecastr. And today he's going to talk to us about his personal experience in fundraising as a founder. So, Steven, glad to have you here. Go ahead and take the reins.
Thanks, Tony. It's great to be here. I really appreciate the opportunity. So just real quick on me and kind of what gives me the right to be here today, speaking with you guys. So my name's Steven Plappert. I am a serial entrepreneur out of Louisville, Kentucky. So I've been in the game for about 10, 11 years now. I've started two companies. I've taken them both through Techstars. One company was a consumer gaming company that I started 10 years ago and failed after 3 years. So I know what that's like. I spent 4 years as a fractional head of finance for early stage companies, just building and managing a lot of financial models, helping with cap raises, just owning that financial function. And then I've been a founder again here for the last four. I've been running Forecastr. We went through Techstars in 2020. We've now raised $9 million in venture capital. We've got a little over 700 customers. We do about $2.5 million in ARR, team of 30. So that's kind of where we're at. So finance guy, startup guy, and I think certainly fundraising and specifically financial modeling is kind of core, to my skill set, and my expertise. So hopefully I can, add some value to you guys today. And so today I want to talk about, how we can use a financial model offensively, like kind of like a secret weapon in the fundraising process. I've seen it be a tool that can get leveraged positively to increase conversion of investors to get investors over the line, and so I think it's a really good kind of middle of the process conversion diligence, kind of push them over the line type of tool. So we're going to focus on how should you use your model in a pitch deck, like how should your model show up, if at all, in your deck, and how can we use that to kind of convert investors from an initial meeting into a diligence process, because I do think of fundraising like a funnel where we need to be converting investors, deeper and deeper as we go. So we're going to talk a little bit about that. And then the real kind of value creation mechanism here is presenting your financial model to investors. That's where I think you can really boost conversion. I think you can drive a lot of investor confidence. You can really, build a lot of trust, if you leverage the model in the right way there. But there's definitely, I find, and I've had the chance to kind of really advise a lot of founders on this. I've seen the natural inclination when sitting down to talk about a model is often kind of to go way deeper than you really need to go. So I'm gonna give some nice actionable tips and tricks on how to use your financial model when you're presenting it to investors in a way that will really help the investor get what they want to get out of the meeting, which is in your best interest. And then we're going to talk about these things conceptually, but like Tony mentioned, we've been fundraising. We've raised $9 million over the course of the 4 years, 3 rounds. Most recently, we raised $4.5 million this year. In a difficult fundraising market, of course, and we're really happy about that. And of course, we practice what we preach. So I thought it'd be nice to just give you guys like a real world example. So we'll go through some of the concepts, and then we'll go through the deck that I just used to raise 4.5, kind of show you, hey, how did I use my model in that deck? How did I use that to convert investors? And then how did I walk investors through my financial model? And my hope would be that, that could help you kind of translate to how you could do this yourself.
All right, well, let's go ahead and get started. So what is a financial model? First thing, I think, just definition wise, like what are we talking about here when we talk about a financial model? And I think of a financial model as a business simulator. So I think of it as simulating your business into the future. That's the ultimate kind of job of the financial model. Simulate your business into the future, kind of help you understand. And in this context, it should help investors understand, what does the future hold for the company? What is your plan? How do you get from where you are now to the pot of gold at the end of the rainbow? I think that's ultimately where a financial model can like add value in the fundraising process is, an investor wants to understand, well, here you are today, but how are you going to get to that exit point where I can expect a big return on my investment. And that is a game of the future. That is a game of kind of, the future. And I think a model can really help us tell that numerical narrative, which helps us kind of, draw the low risk path, so to speak, to that pot of gold. I think that's where I think a model can really shine, is like, how can we back up the story that we're trying to tell to investors, because it is a storytelling game, and how can we use the model and use the finances of the company to, to add weight to that story and to ultimately tell a story that resonates more with investors, that's more convincing. So that should be the mindset here. It's like, how can we use this model to tell a story, right? It's a storytelling tool. And I think on the front end of any raise, you should be using your financial model to plan. I mean, your model is a planning tool. You want to use your model to answer some of the basic questions that you're going to want to know going into the round. What are the milestones that you want to reach with this round? You got to put those in the model. You got to ask yourselves, what are the resources, the people, the spending, that you need to incur in order to hit those milestones? And what does that ultimately tell you about the cash need, right? Like, that should essentially fall out of the model. So using the model to really plan the raise, plan the amount of capital you need to raise, the use of funds, the milestones, and ultimately kind of back up that story, I think that's where you want to start. And then when you get into the process of talking to investors, they're going to ask a lot of the same questions that you ask of yourself when you're starting the round. So I think referring to the model is a great way to just add weight behind some of the answers you give when you do get pushed on how much money you're raising, or you do get pushed on, what your milestones are and how you're going to get there. A model is a great place to refer to, if you've got one built and you can really speak to it. So I think it's very much a question and answer kind of game, and building trust and building confidence with investors. I think it really happens through conversation and dialogue. And that's what we're going to try to get after when we go through kind of how to present the model to investors. And then the last thing here, just before we jump into how to use the model in a deck, is I think this is a really important topic. I think that a lot of founders that I talk to, they're kind of like skittish about building a model at the pre-seed seed stage. And mostly the reason for that is this sentiment that there are so many unknowns, the numbers are going to be wrong. What's the point? And I think that's missing the point. I think the point of a model isn't really the output of the model as such. The point of the model is it's a window into your level of critical thinking as a founder. It's a window for the investor into, how are you planning to acquire customers? What channels? What level of volume? How are you planning to monetize? How are you planning to scale your team? Have you actually even thought through that? Do you actually have a plan? And can you communicate that plan? Can you articulate that plan? Are you set up well to lead your team? I think those are the types of things we're trying to prove to investors. And at the Series A stage and beyond, a financial model really becomes more like table stakes. You're not going to get as much brownie points or extra credit, so to speak, for building a great financial model at that stage. It's just expected of you. But there's a lot of founders out there, shooting from the hip at the pre-seed seed stage. And I think their mistake is your opportunity. I think if you really take this to heart, if you build a financial model, and it doesn't need to be exhaustively detailed, it just needs to be solid, and we can talk more about that. But if you build that model and you can articulate it, you can speak to it with investors, it will move the needle significantly on conversion at that pre-seed seed stage, because you're going to show up more prepared than your competitors. And by that, I mean just other founders competing for the same dollars. There's a lot more founders there's a lot more hungry mouths to feed than there is food to go around. So you got to, it's a competitive game. You got to be looking for everything you can do to set yourself apart from the rest. I think this is one that's fully in your control. So I think it's kind of a no-brainer. So that's what I would say to anybody that's early stage in the room. I'd say now's definitely the time to build a model. On the topic of how to use the model in the pitch deck, this is the first place that a model should show up. Going back to that idea of fundraising being a funnel, you have a lot of targets, at the top of your funnel. You're trying to convert those to an initial meeting where you're going to pitch the investor. And in that meeting, in my opinion, you're trying to set the hook, you're trying to build interest. You're not necessarily trying to close. You're trying to convert the investor into a deeper dive where you're then going to convert them into an investor. And so in that pitch deck, you want to lead with the more interest building elements of the deck. You'll see that in mine, but I think near the end of the deck, right before the ask slide, we can just kind of tease the investor with financial projections. And in my opinion, that's all you're trying to do, is really, you just want to signal to the investor that, hey, we've got a financial model. Hey, we're the type of company that makes data-driven decisions. We're the type of company that puts critical thought into how this company scales. We plan, you know what I mean? Like, we've thought through the financial aspect of this business. We understand it back and front. That is the signaling you're trying to give with this slide. And I like to keep it really simple, summary income statement on an annual level. The investor is going to look at this slide, they're going to scan the revenue ramp, and they're going to ask themselves this question. They're going to say, is that attractive enough to hit my return profile? Is that actually worth my time as an investor? Is this founder thinking big enough? They're also going to ask themselves the question, is that reasonable? You know what I mean? Are the numbers flying off the page, which tell me this founder is really maybe unsophisticated? They haven't really given it that much thought because this company is growing like 3 times faster than Slack did or something like that. Like where is this, in the landscape of the deals that I see? It should be kind of in that Goldilocks zone of attractive but reasonable. That's what you want to kind of trigger in the investor. And this is just the output of the model, right? This is the high level output of your financial model. So it naturally begs the question, where did you get those numbers? Anybody can put numbers on a screen, but like, where are those actually coming from? What assumptions? Is there a model to back it up? Like, where are those numbers coming from? And that's exactly the question that you want. That when we think back to converting, I think of that initial meeting as my only job is to build interest, to set the hook and get the investor converted into a secondary meeting. That could be a product demo. That could be a go-to-market deep dive. That could be a financial model walkthrough. And I want to be prepared to do any of those. So wherever the investor leans in, I can say, you know what, that's a great thing. I'd love to dig in on that. Let's set up a second meeting and go deep. And that's how I'm going to build trust. That's how I'm going to get them leaning in and get them investing in the company. So when I get to that financial forecast slide, I want to be preempting that. I want to be the type of founder that says, hey, look, I've got a great financial model. We know this business back and front. I would love to sit down with you for an hour next week and walk you through that model, show you just how well we understand this business. I think it'd be a great foundation for a strategic conversation about the company, and I think it would really help us understand if there's a deal here. Like, I think, anytime you can paint that picture and kind of show an investor what that next meeting could look like, you're just going to get more investors converted into it than if you leave it really open-ended and you just in that first meeting saying, hey, well, I enjoyed this. Let me know where you want to go from here. I think you're making the investor do more work at that point, and it'll lead to lower conversion. So just flash that forecast on the slide, just kind of tease them with those projections, get them to be thinking or asking, where did you get those numbers? And that's going to naturally kind of lead into, it's going to fall right into your hand where you're going to say, hey, we've got this great financial model. We are the type of founding team that makes data-driven decisions. We know this business. We'd love to sit down and walk you through it. And that's where the financial model walkthrough comes in.
Hey, Steven, I have a question coming from the audience, and I feel like it's a timely one so that we don't go too far away from the current point of this discussion. So the audience member is asking, what are the most common next steps you plan for? We heard product demo, financial model walkthrough. I assume this is part of the overall pitch deck type of question.
Yes. So I think of myself in fundraising as like, I'm a bit of a chameleon in a sense of like, I'm going to have a plan for a variety of different next steps that I know that I can do well. The 3 that I typically will go for is something around product, because investors love to understand your products. Or product demo makes a lot of sense. Something around go to market, because like for me, distribution is what matters most. So I want to lean into distribution and go to market. I want to prove to this investor that I understand that back and front. And then the financial model, something that gives them confidence that I am really strong on the finance side, that I will be a good shepherd of their hard-earned money. So there's those kind of 3 that are my, I would say, go-tos. But then it kind of depends on the investor. Some investors will be more interested in the financial element, and I want to push them towards that model walkthrough because that's where they're leaning in. Some investors, they don't maybe care as much about that. They're really interested in product. So, for me, a product demo is a model walkthrough. So they're like one and the same. But, like a product demo is where I'd lead. And then, but if this investor is more asking questions about customer acquisition, I'd lean into that go-to-market deep dive. So it depends on the investor and where their interests lie.
Got it. Great. One more question, and we'll keep going. So it sounds like from one of your earlier slides that you do recommend including some financial model snapshot in the pitch deck. Now, in the instances where you're trying to get a first meeting and the investor says, "Yeah, why don't you send me your pitch deck first for me to take a look at?" I know a lot of founders are a little bit skittish in including numbers within pitch deck that gets sent out into the quote unquote wild because they're afraid that, perhaps competitors might see it, right? So what are your thoughts on that?
Yeah, it's a great question. So my philosophy on sending decks in advance of meetings in general, is largely to not do it, but it has, for me, it has nothing to do with it getting into the wrong hands. For me, it actually has everything to do with something I feel strongly about in the modeling context as well, which is controlling the narrative. I think for me, as a founder, like I want to control the narrative. My deck, my model, those are supplemental resources that supplement a narrative that I'm telling. And I'm the founder. I'm bringing the heat, the passion, the purpose, the excitement. An investor's going to feel that coming from me a lot more than they are from a deck or a model standalone. So I really try to kind of hold those resources hostage to get meetings. And if I'm asked for those, I very politely will say, hey, actually my deck, my model, those are supplemental resources really designed to back up a story and that I tell. And so if you're interested in this, and I totally understand if you're too busy, but if you really are interested, I think it's well worth our time to sit down for 30 minutes and have a chat. I'd love to do that. Is this time or that time available for you? And it's not to be kind of cheeky or anything. It's just because like you want to be in the room. That FaceTime is where investment really comes from. Now, if this is a great investor and they're a real, just amazing investor, you really want them, and they respond back to that saying, "Hey, man, look, I get it, but I'm really busy and I'm just not going to be able to fit this in. I'm going to need to see a deck," or whatever they say. Then sometimes I do bend on that, but I don't share numbers. To your point, I share a slim intro deck, one that isn't really designed to give them all the answers. It's just designed to wet the whistle, and just kind of hits on the really, really high points that are difficult to pick at. Something that is going to leave a lot to be desired and is going to hopefully convert the investor into that initial meeting, because that's where I shine. So that's what I would say on the deck side and the model side as well.
Great. Awesome. Thank you.
You got it. And so that kind of leads in perfectly. It's like in terms of the tips here for doing this model meeting, you gotta hold the model hostage. Don't share the model in advance. One thing that I also think supports this point is that if you think about investors and you think about their mindset, they're approached by tons of founders every month. Let's say 50, 60, maybe 100 companies they talk to in a month. Maybe they can only write one check a month, right? I mean, some partners only write multiple checks a year. They have to say no so much more than they say yes. So their brains are predisposed to find reasons to be out. If they weren't, they'd never sleep at night, like if they just got excited about every deal. So like they have to be in that mindset. So if you share these resources in advance, they're naturally going to form a negative opinion about the business. That's where they're geared to do is figure out why should I not invest in this? So you want to be there while that opinion's being formed so you can shape it to your favor. So I think that's really important. I think you got to force these meetings. You got to get the FaceTime, which goes into the middle point here as well. When you get into the meeting, you don't want to be getting into the weeds of the model, explaining all the formulas, that kind of stuff. If an investor asks a deep question, I think you need to answer that question. That's what you're there to do. But you're there to inspire confidence. You're there to build trust. You're there to answer questions, alleviate concerns, remove any kind of barriers that would keep this investor from investing. And so you need to open up a dialogue. It needs to be a strategic conversation. There needs to be a back and forth, and you don't want to be getting into the weeds too quickly. So you'll see this when I walk through mine, but you just want to stay high level strategic. Hit them with an overview. Remember that you're telling that story. So, hit on the key points that you think are mission critical, and then open it up for a dialogue, get the investor talking, get them to expose their concerns, ask questions, and start to chat. That's where they'll start to build trust with you is in that back and forth. They'll start to say, hey, this founder, it really seems like they're on top of it. They really give me comfort in these areas, and that's going to reduce the risk profile in my mind, which creates more value in the investor's mind. So I think that's a critical piece that I hope will be, more obvious when we get into the mock meeting here in a second. And then the last point, it maybe also is an obvious one, but just, I do think of fundraising as a game of momentum. And so I think always following up, always identifying a clear next step at the end of every meeting, making sure investors don't kind of fall into email purgatory, just so that you can keep things moving, because momentum's so critical in fundraising. And I am fully team share deck, share model after you've met. I like sharing, a link to my Forecastr model or an Excel file after the meeting, because the investor deserves to be able to dig in, on their own. I just want to set it up first and I want to color it first. So that's why I kind of hold it for the meeting, but good to follow up after the fact. All right. Okay, cool. So we got about 20, maybe more minutes here. We'll leave some good time for questions as well. So let's get into the example. I want to kind of take you guys into my world and say, hey, look, what does this look like in practice, to do what I'm talking about? So like I mentioned, we raised $4.5 million this year. And I also raised $2.5 million 2 years ago. Very similar process for both rounds in terms of leveraging the model. So here's my deck, just to kind of walk through it. I lead with some of those interest building elements. So I like to call it proof of vision, proof of execution. So I'm saying, hey, look, like we do online financial models. Look, I'm saying FBA, big market built on this archaic software. So trying to do a proof of vision. The Carta of financial models, proof of vision, trying to really prove that vision. Big giant data set of anonymized financial health data, proof of vision. We're like these other monster companies that have plucked business functions away from Excel. So there's all this proof of vision stuff that's designed to set a hook, get the investor thinking big. Then I move more into proof of execution, tried and true business model that scales, great growth metrics, great retention metrics, great unit economics, great strategy. I want to get the investor thinking, hey, I'm a smart founder, strategic position, just, unfair advantage on distribution, differentiation through a human approach, the team itself, right? So I'm leading with those elements that I think are more designed to get the investor leaning in, get them excited, build interest, not leading with the financial model, and then right before the ask, right before I'm saying, hey, I'm raising $4 million to achieve an objective, to reach these milestones. I'm saying, hey, I'm flashing the forecast. I'm like I said, I'm flashing the forecast in front of them. And when I get to this slide, I'm more or less saying, hey, look, we've got a great financial forecast built for the company. Look, I recognize you're an early stage company. There's a lot of unknowns, but we think it's really critical to set a plan for the future and manage to that plan. We do that really well. We're a data-driven company. We make data-driven decisions. We're agile. And I think we've got a really bright future. I think we've got a really great company on our hands here. And if I've done my job here today and convinced you of the merits of this company, I would love to spend an hour with you early next week, walking you through the financial model that backs up this forecast and just talking more about the business, talking about how we acquire, how we monetize, how we retain, how we plan to scale our team. I'd love to get your feedback on that. And I'd love to get you kind of deeper into the business. I think that's really going to help us understand if this is a good deal for both sides. Something like that, I like to say, where I'm creating a picture of what that next meeting could look like. I'm kind of showing maturity in that way. And I'm really leaning in, to the financial aspect of the business. I'm kind of telling the investor some of what they want to hear, that I make data-driven decisions, that, that we're the type of company that has a plan. And I think this is a great lead into the ask, because I can go down that forecast and say, and look, and that's why we're raising 4 million. Like, our goal is to hit 7 million in annual recurring revenue over the next 2 years. If we're going to do that, there's a number of resources we need, which we can walk through in that model meeting. But like the model says, we need 3 million, and we're smart enough to know that, every model is a little bit optimistic. So we want to make sure that we don't have to execute exactly perfectly. We want to build buffer into the plan. So that's why we're raising 4 million. We think that's ample capital that's going to get us to 7 million. And at 7 million, we feel really good about our opportunities to raise the next round of funding and kind of continue on this journey. So, I'd love to have you in. So I think it just naturally leads to the ask slide, which should absolutely be based on milestones, not runway and hiring and that kind of stuff, right? You're raising money to reach growth milestones, not to hire people. That's just a resource, it's a means to an end. So I think that's really important as well. But that's how I use the model in a deck. So then let me jump out of here. Forgive me for just 1 second. I'm gonna jump over here. So now let's say, I convince the investor, right, that there's some merit to this business, right? And they want to take me up on that offer and sit down for a second meeting to go through the model. So I'm gonna walk you kind of through mine. Now, my model obviously lives in Forecastr, shame on me if it didn't. But I do just want to say very clearly that what we're going to walk through today, it applies just the same if your model is in Excel or Google Sheets, Pry or Causal or any other solution for your model, right? So no matter where your model lives, this playbook works just the same. So you definitely don't have to use Forecastr to execute this playbook. But this is where my model lives, of course. So this is my model. This is the model that I actually use to run my business. It's our real model. These are our real numbers. This is my active scenario, and I've got a number of others that we kind of use to test things out, set goals, etc. So we're here in this meeting. So how would I advise you to run this meeting? So first, I want to say just kind of high level how I would go about it. So in terms of high level story arc, I think there's 3 main kind of parts to the meeting: revenue, use of funds, and big picture investment. So we're going to start with revenue. We want to start with walking the investor through how we acquire, how we monetize, how we retain, like how we generate revenue. Why do we want to start with that? Well, we want to start with that because that is typically what the investor cares about the most, and for good reason, right? I mean, revenue is where most of the risk lies in all of our businesses, right? In all of our businesses, it's generating revenue where most of the risk is, not managing expenses. So because of that, investors are predisposed to have questions about how you generate revenue, how you acquire customers, unit economics. They're going to have concerns about that area of the business. Most of their interest is in that side. So we want to start with that because we're there to answer their questions. We're there to alleviate their concerns. We're there to inspire confidence in them. So we want to focus our attention on the areas that they care about. We don't want to just tell them a bunch of stuff they don't need to know. So like the first thing we're going to walk them through is, hey, like, how do we acquire? How do we monetize our customers? What are our revenue milestones? Things like that. And I'll go back through and do this kind of in a mock way in just a minute. But so that's the first stop on the train. And then you're going to have a really rich dialogue about revenue. Once you get through revenue, there's a natural kind of logical progression where you can say, look, if we're going to hit these exciting revenue milestones for the company, we need resources. That's why we're raising this round. So here are the people that we're going to hire. Here are the skill gaps that we need to fill. Here are the functional roles that we're going to hire a number of over the next 2 years, like really focusing on the hiring plan over the horizon of their investment. Talking a little bit about major expenses maybe that you have, sales and marketing expenses, cost of goods, things like that. So there's kind of a use of funds component where you talk them through how you plan to deploy the capital to hit those milestones, but it's all about the milestones. And then at the end, you're going to wrap it back to what you showed them in the pitch deck, right? You're going to wrap it back to this annual picture of the income statement, and saying, hey, look, like big picture, we do what we think we're going to do. We raise this round, we hit these near-term milestones. This is the long-term path that we're on. We think this is a really exciting path, and we'd love for you to participate in this as an investor. Like, I've really enjoyed this conversation today, and I'd love to see us get a deal done here. So like, shoot me straight, where are you at with respect to making an investment decision? What other information do you need from me in order to make a decision? And like, how can I make it a yes? Because I'd love to see us get a deal done here. I like being direct with investors in that kind of line of questioning at the end, being optimistic, asking for the business, and really trying to get a direct read from the investor as to their level of interest. It's in an investor's best interest to kind of sit on their hands, and delay the process unless there is a sense of urgency, like the deal's super hot. So you just want to try to get a read, and that's best done in person or, through Zoom, where you can ask a direct question and you can stare at someone's face and you can see how they react to that, and like, are they leaning in? Are they saying, honestly, Steven, this is really interesting. Here are the few elements that I still want to get comfortable with. You want to get a sense of where they're at so that you can give them what they need to make a decision, whether that's a yes or a no, right? A quick no is the second best answer. So we want to be direct in that way. And, it's just something that I've seen even in my own career, I didn't do a good job of early in my career. I was a lot squishier there. I'd just say, hey, let me know where you want to go next. And I think you lose leverage in that. And I think you lose time in that. I like to end these financial model walkthroughs looking at the big picture, the pot of gold at the end of the rainbow, talking about that investment round, and really trying to get a clear picture from the investor of their level of interest and what the next step is to continue upon the path of them making a decision. So that's the final piece. You're going to start with what the investor cares about, which is revenue. You're going to take them through use of funds, and then you're going to end with what you care about, which is the investment, and really try to get a read on where they're at.
Hey, Steven, we had a question come in a little bit earlier. If you could deep dive into the revenue forecasting piece. The question was essentially for a lot of early stage founders, building out the expense model is the easy part because that's a known variable. From the revenue side, what are your recommendations for forecasting revenue? Now, for the audience, obviously Steven is showing his own startup's product, and so he's showing us screens. The purpose of this webinar isn't to do a demo of Forecastr, but I think there's certain things that we want to learn from your experience, Steven, around how do you think about forecasting revenue projections if you don't have a ton of perhaps historical data. I have my own inputs on that, but I'd love to hear what you think.
Yeah, it's a tremendous question. It's a question that comes up all the time. And as a startup, right, I think one of the hardest things that we have to do as founders is we have to make a bunch of judgment calls on less than optimal data, right? Big companies that got tons of data, forecasting's easier, everything's easier, they got a lot of data to work with. Early stage companies don't have a lot of data, so you have to make a lot of assumptions. You have to make a lot of judgment calls. The same is true in forecasting. I think if you're an early stage company, if you don't have a ton of data, you have to make assumptions. You have to kind of put your strategy hat on, and you have to say, hey, what channels do I think are going to be most fruitful when it comes to customer acquisition, and why? Are there tangential companies that are complementary that I've talked to that use those channels? Are there some sort of like early proof that I have that those channels work? What channels do I think are going to work, and what is my rationale for that? I have to force myself to answer that question. Same with business model. What price do I think the market will bear, and why? There are various ways to kind of get at that, but you're going to have to make a judgment call and you have to live by it. So when it comes to forecasting early on, I think it's a mixture of your assumptions as a management team as to what you expect to happen, mixed in with like what kind of needs to happen in order for you to hit your goals, right? Like you need to grow at a certain rate if you're going to attract venture capital. So those growth goals need to be represented in the model. And it's your job to figure out a reasonable path to hitting those goals that you feel like you can defend. So I think that really is the answer. There's a lot of nuance to it. And then the last thing I'll say is if you're a really early stage company, don't go really deep, really granular with the financial model. You'll be stacking unknowns on top of unknowns. It's a lot of false precision. I think you need to build a simple but descriptive financial model, and you should be thinking about it in the frame of storytelling. If there is a channel that is critical to your narrative around distribution, it must be represented in the model. If there is a revenue stream or a revenue function that is critical to your story, that's got to be in the model. So think of your model as backing up your story. What is that story you're telling? How can the model back that story up? And how can you kind of marry the goals that will be attractive to investors and that you want to reach as a founder with what you feel like is reasonable based on the information you have? And then just commit yourself to being agile, to updating the model on a regular basis as you get more data.
Awesome, thank you. I'll chime in my comments regarding that question. So for Mucker portfolio companies, you do have access to our founder portal on our website, which contains a number of different resources. One of them is a growth model that I had presented about several months ago. And again, until you guys are ready for a tool like Forecastr, most of us work in spreadsheets, which is the world that Steven's trying to change. And so in the founder portal for Mucker portfolio companies, there is a pre-built template spreadsheet that's helping to help you plan out your future growth forecasting. That's specifically for growth. And so I highly recommend and encourage Mucker founders to go and check that out if you have not looked at it yet, because that's going to dig deeper. And it's very similar to some of the screens that you see here in the Forecastr UI, in terms of here are all the different channels that perhaps you've tested or plan on testing in the future, and to get a baseline of what your funnel looks like, right? And so I would probably start there and start, just make some assumptions. If you don't have any, historical data, there's plenty of benchmark reports out there as well. The point is, just as Steven mentioned earlier, you want to start somewhere and show that you're thinking about how you plan for growth and revenue, right? And so that's a resource for Mucker portfolio companies. And sorry if you're not a Mucker company, definitely do apply if you are a founder looking to raise funding. We'll talk more about that at the end of the call. But so that's just some recommendations for those of you who are wondering, how do you think about revenue forecasting? You want to just basically take some historical data, benchmarks, or use some sort of assumptions to start planning out different acquisition and conversion rates through your funnel to start building out the revenue forecast.
Awesome. Yeah, great advice. Great advice. Okay, cool. So maybe let's get into a little bit of a mock meeting here, because I want to give you guys an example of what I mean when I talk about this strategic high level overview and opening up the dialogue. So let's pretend for a second that you guys are a prestigious investor group, and I did a first meeting with you as a founder. We went through the deck. You were convinced and you wanted to spend a second meeting to go through the model. Like, here is how I would start to walk you through the model, and then I'll kind of do a timeout. We'll talk about it. So I'd say, first of all, I would say, look, thanks so much for taking the call today. I know you're busy. I know you got a lot of founders to meet with, and we're obviously running a process, but I really enjoyed our first meeting. I think there's something good going here, and like, I'm just excited to be here because we put a lot of thought into this business, and I think we've got a strong handle on it. I'm just excited to have this kind of strategic conversation with you today, get you a little deeper into the Forecastr world and take you through the model. So, first thing I want to do is walk you through revenue. Look, I think you and I both would agree that if we can acquire customers, monetize them, retain them, better than anyone else, we're going to have success. That's where all the value lies. That's where all the risk lies. So we've put a ton of time and energy and thought into that. And I want to walk through that with you first. So let's start with customer acquisition. I think that's obviously where we start. And, we take a diversified approach. So we have 10 different channels that we use to acquire customers. And we are a very data-driven company. We believe that, data-driven decision-making is the best way to go. So we track our customer acquisition on a channel-by-channel basis. You can see our historical data here going back 4 months. We could go back farther if you wanted. And we see what channels are working the best, and we double down on those channels. That's a lot of where our resource allocation is going. When we're raising this round, we're doubling down on the channels that work. You can see we're acquiring about 40 customers a month right now. We have just shy of 700 customers, and we expect to double that, pretty gradually over the next 12 months. By the end of next year, we want to be acquiring about 80 new customers a month. We think we can absolutely hit those numbers, and if we do hit those numbers, that translates to about 2.5, 3x year over year in terms of revenue growth. So we think that really supports a good growth narrative for the company. That'll support our ability to raise a future round of funding. We'll be north of 6 million ARR. So, we feel really good about that. I think customer acquisition is a core company strength. And if we just zoom out really quick, we can kind of look at, what are the big strategic bets that we're placing. The lion's share of the customer acquisition is coming from what we call other strategic networks. That is just us partnering up with venture communities, exchanging expertise for exposure, and that has a natural way of just adding value into the market, of just kind of putting ourselves out there in a positive light. And it's worked really well for us, and we love doing it. So I think that's something that we've learned from Carta and HubSpot and other similar companies. We're trying to emulate the greats here. Another big strategy for us is what we call founder investor referral loops. When we get our founders in, as a customer of Forecastr, we want them sharing the model to investors. Investors love those models. They share it with other founders. Carta really leverage these viral loops efficiently to create the market position that they've created. That's something that we lean into really hard. I'd be happy to talk more about that. And then tertiarily, it's all about domain authority. It's a credibility driven space. We want to be domain experts. We put a lot of energy into education and content and SEO. So I think that's going to be big as well. So, high level, that's a little bit about our customer acquisition, where we are right now, what our milestones are over the next 12 to 24 months, and just like big picture, some of the real strategic bets that we're placing. So I'd love to just stop there and say, hey, like, what questions do you have about customer acquisition? Like what concerns you even about our customer acquisition? Let's dig into that. Let's talk about that. And then we can jump over to revenue and talk a little bit about how we monetize these customers and our LTV and stuff like that. So, pause there. That's the style that I like to do. And just a couple of notes on that. I didn't tell you anything about the nitty-gritty assumptions of the model. I didn't really dig into the weeds at all. Just high-level strategic overview. I thanked you for your time. I communicated that we have a culture of making data-driven decisions. I showed you where we are right now, where we're going in the near term, what that means in terms of revenue, big picture strategy. I just want to give you a light dip, into the model. And then I want to let the investor drive. I want to let the investor dig into a certain channel and ask me a bunch of specific questions, or ask me about competitive landscape, or ask me about customer segmentation, or ask me about CAC, whatever. And then I want to dig into that with them and really create that back and forth.
Great. We do have a question that came in on your screen. You show a forecast going all the way out to 2028, 5 years. So do you recommend going out that far or even farther? Or, what's the sort of, in your experience, reasonable or ideal time frame to forecast out?
Yeah, great question. So in my experience, if you're looking to raise capital, 5 years is the market standard in terms of projections. I think you can go out farther or less far, kind of depending on the company. If you're like a pharmaceutical company, you may go out 10 years plus, because it may take you 5 years just to get to revenue. But generally speaking, you want to forecast out until the pot of gold is the answer. Basically, it's like you need to show the investor you're getting sufficiently large to really excite them. So if you just show a forecast out 2 years, even if you hit good growth metrics, if you're not really getting to a level that would really make the investor interested in investing, it's not going to get them excited. So I think you need to paint that long-term picture. 5 years is typically good enough, and show them what the business looks like at maturity, so that you can show them at a minimum that like you're thinking sufficiently large. Like they want to know where your head's at as a founder, and you communicating that 5-year vision and plan. That's a big piece of that. One last point. You operationally, 2 years is, I think, the edge of what you could possibly predict. Years 3, 4, and 5, it's pure story. Like you're just telling a story, but that doesn't mean it's irrelevant. It's incredibly relevant. Like you need to be telling that story. You need to be, you're the number one evangelizer of your company. So you need to be evangelizing in that way. So 5 years is my recommendation.
Cool. Thank you.
Yeah. So we'll kind of wrap up here in just a second. I'll say, that's the kind of style we're going for. High level strategic overview, right? And the dialogue's the most important piece. So just I think I talked for 3 minutes there or something, setting up customer acquisition. So hold yourself accountable to that. Don't word vomit on the investor. 3 to 5 minutes in a setup, and then give the investor the opportunity to ask questions, dig in where they want, answer those questions well, alleviate their concerns, give them confidence, and then keep moving. Watch the clock and say, hey, well, let's talk a little bit about revenue. One of the things I think is important to do on revenue is don't assume the investor remembers your business model. Like they meet with a lot of founders, reiterate that, remind them that, hey, we're a SaaS plus services company. Right now it's a 60-40 split, but over time it'll be 90-10. And here are some of our SaaS plans. Here are some of our services plans. Here's how that works. So talk to them a little bit about business model. Talk to them about the evolution of your business model. How does it change over time? How do you maximize LTV? Those are some good high level sound bites to give them. But just like on customer acquisition, we want to talk about milestones. So we want to be saying, hey, here's where we are right now. We were able to 2.5x year over year, over the last year. Here's where we're going over the next year. We're getting north of 6 million ARR by the end of next year. We think that'll really set up that next round. So talk about those milestones. Similarly, open it up, give them the time to ask questions. They may want to talk about unit economics. They may want to talk about churn or pricing or just your product in general. And that's fine. Because what I like to tell founders too about the model walkthrough is remember that the model's not the point. The model is an excuse to have a strategic conversation about the business. If the investor wants to talk about product, talk about product. If the investor's like, hey, how are you going to beat your competitors? Talk about that too. It's not in the model, but who cares? The point is you're in a meeting with an investor, you're engaging in a dialogue. So just, go with the flow, kind of take the conversation where it goes, bring it back to the main flow, when you feel it's important, if you feel like it's getting off track, and just keep working on down the line. So you probably get the flavor at this point, high level strategic overviews, lots of dialogue. So I'll just kind of jump back to the end where you want to watch that clock. And when if you got maybe 10 minutes left or something like that, make sure you do jump back to that summary income statement, close the loop, and just reiterate to the investor that like you feel very confident that this company is onto something big. Like you really think that this is a great company. You enjoyed the conversation and like you'd be really interested in having them as an investor. You think you'd be a great fit for their portfolio. And you'd love to understand where they stand. Like you'd love to see, I'd love to see us get a deal done here. Where do you stand? Like have those conversations, push yourself, into that perhaps, out of your comfort zone, because they may respond and say, no, look, I really, this isn't my cup of tea or something, but you really want to kind of force yourself to do that. So have that kind of courage to make those direct asks. I think that'll go a really long way. So that's what I got for you guys. I hope that is helpful here. And, we've got some time for questions and then we can, kind of, close out. And we answered a lot of questions along the way. So.
Great, thank you. Do you mind flipping back to the previous deck? So we do have a question from the audience, which is around profitability. When do you, from your experience, and I'll give you again, I'll chime in as well. When do you feel investors expect that your startup to become profitable?
Oh, great question. So, if you're going for venture scale, and you're really shooting for the moon, I wouldn't expect profitability before Series B for sure. I would say maybe around Series C, would be when you could start to kind of, you could certainly, I would think like, if I'm thinking about raising a Series B, I'm thinking about, hey, like I am intentionally unprofitable. Like I could become profitable, but I am intentionally levering the company up for additional growth. So in my Series B narrative, I would probably be talking about the fact that, hey, we could definitely become profitable, reduce risk, but we're looking to lever up for these reasons. And here's the growth forecast. So that would be my general rule is maybe you raise a Series B when you're doing like 7 to 10 million in annual revenue. So maybe when you're up north of 10, maybe at like 20 million in annual revenue, you could, in theory, turn a profit. In your model, if you really want to get aggressive, you could show an operating loss. I would think even at that level. But honestly, this is one, Tony, I'd be really interested in what you have to say on this one.
Yeah. So first of all, I'm not on the investment side of Mucker, so that's a disclaimer. And also, every investor is slightly different, right? And there's different goals. But here's what I would say. And in terms of being, in my past life, I was on the other side. I was, running growth for startups, and so I had to present to a lot of VCs in the past. And so I think the notion around profitability is really about, a couple different areas. Efficiency, being capital efficient, right? And that has to do with, your burn rate and, your growth and acquisition. But also there's another part of, these days where a lot of investors are placing heavier emphasis on NRR, net revenue retention, as well as, looking at your overall growth rates, right? So a combination of those things will give, again, I don't want to speak on behalf of all investors out there, but if we understand that if you have, solid NRR, over 100, 120%, right? And your overall growth rate is 20, 30% month over month, as an example, just kind of throwing some benchmark data out there. All right. That will potentially signal to an investor that, hey, you're capital efficient and you may not necessarily be profitable. Maybe you haven't broken even yet. But for every dollar that you invest in this company, you can expect growth, up and to the right, right? And so it doesn't necessarily mean that you're profitable, but you have the capability to scale, the venture scale type of environment, right? And so yes, being profitable is always great, but you'll be surprised for and when I say you, just generally, not necessarily you, Steven, but I think a lot of people don't realize that there are startups that grow and go public and they're not profitable. There's plenty of companies that are in that bucket, right? And so, I urge everyone who are still with us to think about, okay, how do we leverage financial modeling? How do we understand how our business currently operates, and also how do we project for the future? Yes, a big part of it is going to be, just, I don't want to say making stuff up, but we're predicting, right? We're trying to forecast out, try to get as accurate as possible, but you're also trying to sell, the vision of your company. Don't make stuff up, but you don't want to also sell yourself too short, because that's the other side of the coin, where investors aren't looking to, invest in a company that is, just minimally getting by, right? And so, yeah, I think there's a lot of great points that, Steven, you brought up around, how do you leverage your financial model for pitching? And so, yeah, I think at the end of the day, there is that, like a good approach to go about it. So yeah, anyway, again, I'm not on the investment side, but I've seen this movie a couple times. So another question is, what is the benchmark annual growth rate to indicate capital efficiency? I'll jump in, but I'd love to hear your experience as well, Steven. I think what we typically try to encourage our portfolio companies to strive for is about 20 to 30% month-over-month growth. Now, from a year perspective, there's the notion of triple, double, double, double. I don't know if any of you guys have heard about that. That's always a great model to try to strive for. Now, that is, difficult, but we want to shoot for the stars. So triple, double, double, double just means, from a top line revenue perspective, ARR, you want to triple from year 1 to year 2, triple year 2 to year 3, and then double, double, double. That's the path to get you to 100 million in ARR. So that's what we typically see. How about you, Steven?
Yeah, I mean, I wouldn't really have anything to add to that, honestly. It's similar for us. I think when you're south of $1 million in ARR, or just annual revenue in general, you certainly might be able to hit even higher, maybe 5 to 10x year over year. Because you have a small denominator. If you start with 200,000, you might get to $1 million the next year. But then as you get bigger, double or tripling year over year, I think is definitely solid. In my mind, you got to at least double, or you don't even get like a seat at the table. If you're above 3x year over year, then you're generally going to be viewed pretty positively by investors in my mind. Now, doesn't say maybe as much about raw capital efficiency, because you could be spending like a ton of money to generate that triple. So there's that element. There is, can't remember the benchmark off the top of my head, so I apologize, but and it might be Bessemer or maybe it's another, but there's a capital efficiency ratio out there. Maybe you could, if you're out in the odds, you can Google it. But there are some benchmarks around capital efficiency, which take into account kind of growth and burn, to give you kind of a benchmark there. So that's something to look into as well.
Yeah, there's certain metrics like the magic number, like stuff that people who've been in SaaS, B2B SaaS specifically look at. But yeah, I think, what I would typically advise our portfolio companies is, measure a growth rate, measure an NRR, understand your CAC payback, and CAC payback period. And all of these items or these metrics will help give you, as well as your investor or potential investor, a better idea of how operationally efficient you are, so that they'll feel much better about writing a check to you. Okay, so we're out of time. Next steps. If you have any questions regarding financial modeling, Steven is kind enough to provide his email address. So go ahead and reach out to him if you have questions as a fellow founder. I'm sure he's more than willing to help other entrepreneurs out. Reach out to me as well, and your Mucker advisor if you are a Mucker portfolio company. Steven, thanks for joining us. This was great. I think there's a lot of questions around, how do you think about forecasting your financial model? A lot of the stuff that you covered is extremely important and certainly top of mind for many of us, or many of the people in attendance. Thanks again, everyone, for joining us, and we'll see you in the next session.